Good morning, everyone. Thank you for joining. We will get started in a moment, just making sure some more attendees have a chance to join. Good morning, everyone, and welcome to the second Capital Modernization Project information session for the proposed capital rule consultation. My name is Christina Panaggio. I'm one of the stakeholder engagement specialists here at BCFSA. I'll get us started and situated with some pointers about the format of this Zoom webinar session. Today's webinar is scheduled for 60 minutes, but depending on the number of questions, we may finish early. Your microphones have been muted and you are in listen-only mode. Similarly, you will not be on camera as your video is off. At the bottom of your screen, you will see two icons. The Q&A function, this is where you can submit your questions. Please don't use the chat box to submit your questions so that we don't miss them. As you are in listen-only mode, your questions will need to be typed into the Q&A. However, you are welcome to use the chat function to send a note to the panelists on today's call. There will be time at the end of the presentation for questions and for a question and answer period. And finally, we will be recording today's session and it will be available on our website as soon as possible. Next slide. Before we begin today, I would like to acknowledge that we are gathered here on the traditional territory of the Musqueam, Squamish, and Tsleil-Waututh Nations peoples who have been stewards of this land, which we all call home for many generations. While we meet today on a virtual platform, many of us are in different locations throughout the province, and I would like to encourage you to take a moment to reflect and acknowledge the traditional territory you may be calling in from. I would like to introduce you to the speakers here today. Nez Aquino, our BCFSA's Senior Vice President, Financial Institutions, is the executive sponsor for the Capital Modernization Project. Rebecca Lowry, Director Reporting and Risk Assessment, is the project sponsor. I'd like to go through today's agenda with you. This is the introduction. Next, we'll hear from Nez on the background of the project. Then we'll have a project update with Rebecca. We'll go through your questions about the proposed capital rules and talk about next steps. And next, I'll hand over to Nez Aquino to start the presentation.
Thanks very much, Christina, and good morning, everyone. I think we can go to the next slide. So many of you know that the first time a capital framework was introduced in the BC credit union system was the year 1990, actually, and it hasn't changed much in the last 35 years. This is our endeavor to modernize the capital framework that needs to adapt to a time when the type of businesses, the type of product lines has changed quite a bit in the last 35 years. There's been so many new standards, Basel III standards, and other internationally recognized standards that have come to fray, and we are endeavoring to adapt our capital framework to the year 2025 and to those standards. In doing that, our objective is to increase the quality and the quantity of capital that can actually absorb loss for unforeseen events. Now, throughout the project, which began about 3 years ago here, we have consulted extensively. We've actually held more than 50 meetings, either collectively with credit unions or individually with credit unions, with government officials and others relevant to this conversation over the last 2-3 years. And as you know, since July, we have been receiving the parallel reporting for both before and after version of this picture. And the evidence is quite clear that there is a certain degree of readiness, adherence to the rules. We are receiving the quarterly reports now for most institutions over the last 6 months. And generally speaking, we're at a time when the organizations are ready to adapt to this change. Next slide, please. Now, as you know, we have really taken our time to make sure that we are assessing the amount of capital that must be allocated to a specific business activity commensurate with the risk of that business activity. And so we'll spend a bit more time talking about that in the remainder of this conversation. And of course, I invite all of you to read the rule in detail. A couple of years ago, we made a temporary adjustment of removing the 30% cap on commercial lending. And when the rule comes to place, this rule of 30% will be eliminated permanently. So there will no longer be a 30% cap on commercial lending. A portion of general loss allowance can now be included as part of capital. We are eliminating the counting of system capital. These are the earnings of Central One, Stabilization Central, and QDIC funds as part of system capital, because we are certain that if there is a duress somewhere in the system at any moment in time, those dollars will not be able to absorb the losses and really be helpful in navigating the next chapter of that credit union. They cannot absorb losses, and therefore they cannot be counted toward capital. We are treating membership shares as a source of Tier 1 capital, so that continues under the Made in BC approach. The next slide, please. And where I really wanted to spend some time with you is to demonstrate the kind of before and after picture for the system at large. So for the 26 credit unions we have in the system today, the first column here is representing the risk-weighted assets and the capital under the proposed rule. The middle column is representing what it is under the current rule that we're operating under, which has not changed since 1990, and the difference. So as you can see from the table, when as a result of the changes we're making, all else being equal, the risk-weighted assets of the system are coming down by a little over $1 billion, from 39.3 billion to a little over 38 billion. That is largely as a result of the fact that we are, instead of counting all commercial lending at the same risk weight of 100%, as if all lending is the same risk, we're actually making sure that the lower risk categories in that commercial lending can attract risk weightings much lower than 100%, which is very much aligned to what OSFI does today. We're also doing the same with retail lending. You know, instead of having 3 or 4 distinct points of risk weight assigned to residential lending, we're actually making sure that the risk assignment, the capital assignment for that residential lending is commensurate with the risk activity of that. And when we look at the actual regulatory capital that shows in the picture in before and after, there's an uptick, you can see by a small amount of about 206 million. And the capital adequacy ratio is higher by about 92 basis points. To be clear, the current rule, the middle column there, excludes system capital, which is the way we've been counting it as at BCFSA for the last 2-3 years, and we've been communicating our message that we invite credit unions for the last at least 2-3 years not to consider system capital as something they can count on, as something that can absorb losses. And so when we look at the before and after picture that emerges in the system across the board, today we have about $440 million in surplus capital that is ready to be deployed before the system collectively reaches its internal capital target. And under the proposed rule, that number is going to go up significantly, about $770 million, as a result of the changes that we're introducing, from including part of the general loss allowance to capital, from making sure that we have really thought through the risk level of a specific type of commercial lending, residential lending, and assigning an appropriate risk weight to it rather than kind of general numbers such as 100% for all commercial lending. And by moving away from capital deduction for investments to risk weights assigned to those investments, and that plays favorably to the overall capital adequacy ratio. So generally speaking, when we look at the distribution in the system, we see that the risk-weighted assets for almost all institutions went down. For almost all institutions, the capital amount went up, and therefore there is a bit of a relief in the capital adequacy ratio in the way we define capital and risk-weighted assets going forward. So with that, I'll turn it over to Rebecca to walk us through the project update.
Thank you, Naz. So now that we've talked a little bit about the background and rationale of capital modernization, we're going to give a quick update on the project, as well as talk a little bit about the parallel reporting before getting into our question and answer period. Next slide, please. Thank you. So a few admin items. As you can see here, the purpose of this consultation is to really identify areas where clarity is needed or where we would like to identify where the wording of the rule may not operate as intended. To note, the rule follows legislative drafting standards, formal and structured, so it may look different from previous consultation papers that we've issued out to external stakeholders. But the content is consistent with the framework that we've previously consulted on. We encourage you all to please review the rule holistically to avoid misinterpretation. I also want to note that we have extended our consultation period. You can see the details on the slide here, with the consultation running until January 15th, 2026. We ask that you provide your feedback in a couple of different forms, either using the template and the link that we provided in the advisory, and all of this can be found on our website, or general feedback can be emailed to our CU Capital email address. Next slide, please. Thank you. We've all seen this slide before. This is just a reminder that we're currently in the rule development phase of this project, consulting on the draft rule itself. You'll be hearing more from us in the new year, talking about the templates, guidelines, etc., and really focusing on that operational readiness in 2026 as we move forward to our effective date of January 2027. Next slide, please. So a little bit of details on parallel reporting. For Q3, we had asked that only credit unions with assets greater than 500 million submit parallel reporting. So thank you to all the credit unions that did submit that. Looking at the key metrics under the submissions, Tier 1 capital, total capital, and leverage ratio, these were all consistent with the Q2 results, confirming that credit unions remain well capitalized and resilient under the proposed framework. Under the self-assessment tool, risk-weighted assets are about 1.1 billion lower than our current capital adequacy requirements, the current reporting. So what does this mean? With more precise and risk-sensitive risk weights under the proposed rule, we have freed up additional capital for investment and lending activities, which ultimately supports economic growth. These results suggest that the new framework is more risk-sensitive and better aligned with credit union lending policies. It is not constraining capital, rather it's applying risk weights that are more appropriate than the blunt approach under the previous or the current framework. We've heard from some credit unions that this framework will help them manage capital more effectively as they look at their lending portfolios and balance sheets moving forward. Overall, these findings give us confidence that credit unions are ready for the transition and that the framework supports both resilience and competitiveness. Okay, so let's move on to the next slide. So with our updates and background out of the way, we're going to get into our question period, which was really the intent and the purpose of our information session today. But before we do, I do want to talk a little bit and give a little bit of a reminder about the format of the rules. As I mentioned earlier, the format of the rules should be familiar to credit unions. It does align with legislative drafting style commonly used in British Columbia. It's organized into parts and divisions where appropriate, similar to the Financial Institutions Act or FIA. The rules are drafted based on the consultation paper that was released back in 2023 and the consultation summary report that was published in 2024, as well as the feedback received through that process. We strongly encourage you to review the rules in their entirety, focusing on a single requirement without considering the full context, mainly to misunderstanding. If you do go to our webpage, you will find the draft rule and all documents that go along with it there. We have section notes there as well as the advisory and the link to submit feedback on that. Okay, so let's talk a little bit about the panelists that we have here today for our question and answer period. We would like to thank everyone that did submit questions. Unfortunately, we only received a couple questions since our last session, but we have also included some of the questions that we didn't get to at our initial info session at the beginning of this consultation. So we'll be addressing those as well. So our panelists that we have here today were involved in the development of the capital rules and helping ensure that the intent and objectives of the consultation paper and our summary report were reflected accurately and comprehensively as laid out in the rules. Their expertise ranges from legal, policy, data and analytics, and accounting, with significant experience that has been invaluable to the framework. As we move forward to the questions, the panelists will provide responses and some additional comments, providing context. So today we have Carrie Tuvey, our Manager of Policy, Vincent Chow, our Director of Approvals here at BCFSA, Francisca Nigaman, our Director of Risk Surveillance and Analytics, and Silvano Titanel is the consultant on the project, and you will remember him from past consultations and information sessions. So with that, let's move on to the next slide. Okay, so the first question that we received is in relation to the word substantially. So there are a couple of sections in the rule where this word is used. Specifically, we use this in section 9 and 24 when we're referring to the call of tier 1 instruments and tier 2 instruments. And it's included in a definition for indirect investments as well. So I'm going to pass this question over to Carrie Tuvey.
Thanks. So yeah, when we look at this word, you have to look at it sort of in the context of the specific credit union and the activity that that credit union is proposing to undertake. So there isn't a specific definition. We can't give you a specific percentage or that kind of thing, but it really will be kind of context based. And credit unions will need to sort of exercise their judgment guided by what is set out in terms of the minimum capital requirements that are set out in the rule. And so, as I said, it will be a bit judgment and context based. Ultimately, we can't bind the superintendent to a particular number, as I said, or any specific approach. So it's going to be very context specific, but this kind of language is similar to language that's used in similar requirements within Basel and within OSFI. So this isn't really a new thing that's being proposed by BCFSA. It's something that is used in other by other regulators. But it will, as I said, require a bit of judgment. I think we can go to the next question.
Thank you, Carrie. Okay, on to the next question. So the next question received asked about the changes between the capital rule that we're consulting on now compared to the consultation paper and the summary report. So for this one, it's important to understand that the capital rule is consistent with the proposed framework that was consulted on and the following changes as outlined in the consultation summary report. So this rule is consistent with that. Where we're going to see small changes is really in the language. For example, we may be looking to update the language to fit legislative drafting style provide additional clarity. So you'll see changes there. You're also going to see some more changes where we're going to provide additional detail. So one example with that is our capital buffer. And we're providing additional detail on how to operationalize that. And so you'll be able to see the detail laid out in the rule itself. Some other examples look at adding project finance requirements raised during consultation, etc. But with that in mind, I'm actually going to pass it over to Silvano to add a little bit more on this one.
Thank you. Yeah, as Rebecca mentioned, you know, the whole exercise that we went through to transform, if you will, the you know, the consultation documents that you have seen into a rule was quite an extensive exercise, in the sense that you know, we had some sessions with the people doing the drafting, to ensure that they understood the intent and the policies that we were trying to put forward, so that they would be accurately reflected in the rule. That was an extensive process that involved things like, for example, you'll see a myriad of definitions that appear in the rule, which is something that, you know, we weren't laid out in the consultation documents, but the rule, the standards for rule development required that we include a number of definitions. So you'll see that kind of thing that's new in from what you have seen during the consultation as well.
Moving on to the next question. So there was a question received specifically in regards to Section 10, and it mentioned the 10% threshold redemption cap. So it was asked that we provide some additional clarity on this. And for this question, I am going to pass us over to Vincent.
Thank you. Yes, that is correct. Shares that qualify as capital may provide the holders the right to redeem shares, but the maximum that can be requested cannot exceed 10% of all outstanding shares of the same class within any 12-month period. In addition, only the portion of the share capital that are not redeemable can be recognized as capital for the same reporting period. So for the example stated in the question, if 10% of the shares can be redeemable in a given reporting period, then it is correct that only 90% of the share capital associated with that share class can be recognized as capital for the same reporting period. Thank you.
Thank you, Vincent. So on to the next question. There was a question about differences with OSFI, and in particularly, will credit unions that have an OSFI-regulated bank subsidiary need to follow the BCFSA risk weights for consolidation? So for this one, if Silvano could answer that one, please.
Yes, thank you. Yeah, so this is something that came up during the consultation period as well. And so now we've reflected now in the rule the position that we had taken during the consultation period, reflecting the comments that were received. So yeah, so if a credit union, a parent credit union holds an OSFI-regulated bank subsidiary, and that subsidiary's assets are below the 10% threshold, and that 10% threshold is actually defined very specifically in Section 2.3 of the proposed capital rules, then the parent credit union in that circumstance will have the option to follow OSFI risk weights for commercial and personal loans and leases of that OSFI regulated subsidiary.
Thank you very much. For our next question, it was noted that OSFI is currently undergoing a consultation on its capital adequacy requirements guideline, and they've proposed some changes to corporate exposures. So the question asked is, does BCFSA have any initial views on these proposed changes? For this question, I am going to pass that over to Carrie.
Thanks. So yeah, we are looking at what OSFI is doing very closely, but noting that their proposed changes are still in a draft form and they're still out for consultation until February of 2026. But as noted, we are looking at these changes really closely. But I would also just highlight that the new guideline from that is being proposed by OSFI is a bit more in line with Basel IV requirements, whereas we're looking at updates that are more in line with Basel III. Basel IV introduces some more complex requirements, particularly around credit risk, whereas our current framework is less complex. And I would also just sort of flag that we are still doing kind of the initial update from, as noted previously, from what is a very old capital requirement framework. And so we really want to get it to a place where we can get this update out, and then we will be able to do further updates sort of down the road, more frequent updates. That's kind of the plan. That's part of why BCFSA has this rulemaking authority is to be able to make more frequent adjustments to the capital requirements going forward. So as I said, we're taking a close look at those and we'll update as needed in the future.
Thank you, Carrie. So the next question asks about the need for future changes. So similar to a little bit of what Carrie talked about, the financial landscape is dynamic, lots of emerging risks, emerging changes. We also just received a question from the audience here today, and that question from the audience is related, so I'm going to combine them together. And the question from the audience today asked that since this is the first time that the CRR is being significantly amended or overhauled since the 1990s, will there be more regular review undertaking? And it specifically asked if it would be built into the regulation itself, and reference just OSFI and the regular updates from them. So to answer both of those questions, yes, we will be continuing to monitor the risk landscape, what's happening with OSFI very, very closely. We will be taking a much more proactive approach and having regular reviews of our capital rule with regular updates happening going forward. We do not have any specific cadence built into the regulation or the rule itself, but our approach will be much more agile and similar to what we're seeing from OSFI with regular reviews, regular consultation with the credit unions. I'm going to pass it over to Nez to add any additional context to that one.
Yeah, I mean, I think you captured it really well, Rebecca. So as everybody knows, we're living in a much more complex world today than the 1990s when the rule was first introduced. And so we're very mindful of the fact that we need to adapt to what counts as capital or how risk is considered in what kind of business activity a lot more rigorously going forward. And our intention is definitely to update the rule with more rigorous consultation processes, similar to what OSFI does and some of the other provincial regulators, and align to that process. At the same time, though, I will say, I mean, there's a lot of change happening as we're going through this all the time. Like at some point during this process, we're going to also have to draw the line in the sand and say, this is it for this round, taking your consultation into account, which ends January 15th, as you know, so as a reminder. And then we'll have to go through the process of, getting it signed off by the ministry, et cetera. But yeah, so I'll turn it back over to you, Rebecca.
Thank you, Nez. Okay, so this next question really talks about some of the specific BC tailored components, asking about the differences from BCFSA's approach for residential and commercial real estate secured lending exposures from OSFI's standardized approach. We have a couple of slides following this that address this question, so that's why you're not seeing a response on screen. And so I am going to pass this over to Francisca to talk a little bit about.
Thanks, Rebecca. And upfront, I want to emphasize that the methodology that we apply for risk weighting of real estate secured lending exposures is very similar to the OSFI standardized approach. And we made small changes in addition to increase the granularity of the respective lending categories compared to OSFI to reflect relative risk between these categories. And we use additional risk metrics that are aligned with industry best practice and supervisory expectations to better capture.
Francisca, I think we've lost your sound. Hi, Francisca, I think we've lost your sound. I don't know if you can hear us, but we're going to maybe move on to the next question and see if we can get Francisca back up and running and respond to this one. So let's move ahead. The next few are specifically for Francisca. So we're having some technical difficulties here. So I'm going to answer one of the questions that we received from the audience here today while we try to get Francisca back up and running. So one of the attendees today asked a clarification question on one of our previous slides. So in particular, in the background slide, we had a table that talked about ICT numbers, that sort of thing, and how they compared. So the question was, is the ICT comparison based on each credit union's established ICT from their own ICAP process across all BC credit unions? And yes, that is correct. What you are seeing for that ICT number is the weighted average of the ICT levels across the system for all credit unions. So hopefully that provides a little bit of clarity on those numbers. We also received a question about the recording of our session today. And yes, we are recording our session today, and we will have that made available following the session. So just going to check back in with the team and see if we can get Francisca back up and running here.
While we're waiting for Francisca to come on, maybe I will take over this slide, guys, because I know we have more than 60 people now attending the call. And sorry, everyone, we're having a technology issue. And if someone can let me know when Francisca is back, we'll let her continue. But the premise of the question is, how do we approach this process of what risk weight to assign to a residential and commercial lending? Now, as many of you know, more than 95% of the type of lending that BC credit unions do are secured by real estate. And so in our thinking about how we approach this, which is a little different from how banks would do it, who can diverse their loans across the country, a commercial mortgage, in BC versus Saskatchewan versus Ontario, they're all kind of carry a slightly different risk profile, and therefore can be contributed to a risk weight differently than perhaps BC, where it is very, very concentrated in real estate secured lending. So Francisca, I can see you're back. We're going to give it a try again. I was kind of beginning to get into the slide while we were waiting for you. So maybe with that, I'll turn it over to you.
Yeah, apologies. I hope you can hear me now. Can you hear me now?
Yes.
Okay, perfect. Thanks so much. Yanis already alluded to the very high concentration of personal loans that are secured by real estate and commercial loans that are secured by real estate. So through this highly concentration that is dominated by the real estate and commercial, residential and commercial real estate secured lending exposures, the BC Credit Union's risk profile is acutely sensitive to local property market cycles, shifts in interest rates, and borrower income stability. And these are factors that would not be fully captured by one-size-fits-all standardized OSFI framework. So we chose an approach that reflects this reality by embedding metrics that directly assess both the collateral quality through the loan to value and the borrower repayment capacity through TDS on the residential loan lending side and debt service coverage ratio on the commercial real estate lending side. And these metrics are really central to credit risk of real estate secured lending. And this sector-specific calibration ensures that our capital requirements respond to the actual drivers of loss in credit union portfolios. And I want to emphasize that the methodology is still very similar to the OSFI standardized approach, but the changes we made in addition is really this increased granularity of respective lending categories to reflect relative risk between lending categories, as well as these key additional risk metrics that are aligned with industry best practice and supervisory expectations to better capture credit risk. Next slide, please. So the goal ultimately is not to be more or less conservative than the federal regime, but to ensure that capital aligns with true economic risk. And that is particularly critical in a segment that we regulate with very high real estate concentration in lending, as well as limited portfolio diversification. So BCFSA's framework leverages key risk metrics that all credit unions already derive, collect, validate, and act on, ensuring that capital requirements are both practical to apply and aligned with existing workflows. And this proportionate design avoids unnecessary complexity while maintaining sound risk sensitivity, making the regime feasible across the full spectrum of credit union sizes and capabilities. So as I mentioned, the OSFI standardized approach only relies on LTV, loan to value, as a proxy for risk, but this is inadequate to capture borrower capacity for repayment, cash flow stability, or debt sustainability, especially in slowing growth environments. So we need to ensure that credit risk in a capital framework is adequately covered to ensure that unexpected losses are adequately captured in a risk-sensitive fashion. Next slide. So to conclude on this, the BCFSA's framework does not impose uniformly higher capital charges. Outcomes vary by risk profile and type of lending. I really want to emphasize that. And in addition, in well-managed lower risk segments, such as if we pick one example, the commercial multi-residential lending, where the loan has a strong debt service coverage ratio and exhibits moderate loan to value, credit unions face capital requirements that are competitive with or even lower than those implied under OSFI standardized approach. And then at the same time, we ensure that the framework appropriately addresses instances where risks are elevated. For instance, if we take a residential loan with high TDS and extended amortization periods and high loan to value. But I want to emphasize again that the risk weighting that we have chosen is really anchored in key risk metrics that each credit union, irrespective of its size, is already expected and does derive, collect, and store and report on, and that aligns with BCFSA's supervisory expectations. And but to follow up on Rebecca's statement earlier, we plan to be nimble and flexible in our approach, and we will consistently over time review and reassess risk weights and categories regularly. And you heard that we plan for updates in a structured way. And we will continue to perform recalibrations based on information that we will collect over time. Thanks. Back to you, Rebecca.
Thank you, Franziska. Okay, moving on to our next question. This question asked to provide an update on earnings before income tax depreciation as the prescribed DSCR for commercial, specifically for CRE income producing and multi-residential use property. Franziska, are you able to provide a little bit of detail on that one?
Yes, so I want to confirm that we definitely in how the debt service coverage ratio gets derived, we will follow industry best practice, and clearly net operating income will be applied for product types where the main contributor to the income and for debt repayment are the cash flows from the property that serves as collateral on the loan. We will provide more information on expectations to derive debt service coverage ratio and key contributors such as net operating income and EBITDA as part of our reporting instructions and reporting template consultation that is planned for spring next year. Thank you.
Thank you, Franziska. Okay, on to the next question. There is a question asked about updating borrower income information in the TDS ratio. Back to you again, Franziska, on this one.
Thanks. And yeah, in the context that I just mentioned, where we will consult on the reporting templates, reporting expectations in the spring of 2026, we will include further guidance on the refreshing of the total debt service ratios, and that will include confirmation, written confirmation that an update of borrower income information will not be mandatory at the time of mortgage renewal. Thanks, Rebecca.
Thank you. Okay, so those were the last of the prepared questions. And as I said earlier, those questions were based on questions received since the last information session, as well as some carryover questions from that session. We also have a couple of questions that we've received in the Q&A function for today. So the next question we'll talk about is one that we just received on the leverage ratio minimum. So this specifically notes that the leverage ratio minimum requirement is set at 3%. It talks about comparing that to other jurisdictions and would that potentially be increased in the future. So for that question, I'm going to pass us over to Silvano.
Thank you. Yes, so just to be clear, when the question indicated that that the leverage ratio requirements in other jurisdictions may be higher, just to be clear, under OSFI's framework, the leverage ratio does include a buffer only for the DSIBs though, and so the small the SMSBs at the federally regulated SMSBs are not subject to a buffer over and above the 3%. And so, but I imagine that if there's a need at some point in the future to to increase or to introduce a buffer for BC, that will be considered at that time. But right now, I don't believe that that's something that's being considered at this time.
Thank you, Silvano. Okay, we also had a question about what sections of the proposed capital rule would exposures under multilateral development banks fall under, specifically looking at World Bank Group. And so for this particular one, we are going to take that away. Thank you for that question. We didn't specify risk weights for multilateral development banks in the rule, but we will look into this. Risk weights for exposure to government and central banks other than the Bank of Canada are included in Table 8 of Schedule 4 in the rules. So if you want to take a look at that, and we will take this feedback away as part of the consultation feedback. So thank you for that comment. There's also, moving on to the next question we received here today. And this is a question about some of the differences from OSFI. And so it relates a little bit to the discussion that Francisca had earlier, in particular looking at LTV for residential mortgages. I am going to pass that one over to Francisca to talk more about.
Thanks, Rebecca. So the question is, yeah, that under federally regulated banks, they are required to have mortgages insured if the loan to value ratio is 80% and above. And the question is if we could align the threshold that we use for high LTV with 80%. And as mentioned previously, there are some systems compared to the federal regime in our proposed approach where federally regulated lenders need to make sure there is mortgage insurance if the loan to value is above 80%. This is not the case for BC credit unions. BC credit unions can lend for uninsured mortgages, and that is not a requirement, even if the loan to value is larger than 80%. At this point in time, we will keep the threshold to 75% as we proposed. And as mentioned already, we will monitor this over time, and we are open to recalibrate if evidence suggests otherwise. But I also want to mention that if the loan to value is, if the exposure is insured, if there is mortgage impairment insurance on the loan itself, we follow the federal framework and don't expect credit unions to hold any capital for these types of loans. These receive a risk weight of 0% if they are CMHC insured. Thank you.
Thank you, Francisca. Another question received specifically on the BC tailored components of the residential mortgages, talking about the difference in asking whether LTV is more appropriate risk metric versus the additional risk metrics that BCFSA has introduced. So we've gone over that with some of the earlier slides. I don't know, Francisca, do you have anything in addition to add to this discussion?
I can add. So the question is, the Basel standardized, OSFI standardized approach only looks at loan to value as the loss given default side of credit risk, and we in addition look at the probability of default through key risk metrics such as TDS, debt service coverage ratio, and amortization. And I want to emphasize, and we have discussed this before, ideally, credit risk gets captured through a modeled approach, through an internal ratings-based approach, but we think that would be too complex to ask and would not be a good approach that fits for all credit unions, and hence we have increased the risk sensitivity by relying not only on the loan to value, but adding one key risk driver of credit risk, that is the probability of default, into our framework, but still keeping it simple. And as I said, we will monitor this over time. We think this should be a good approach, and we have seen in recent time periods also where there were risk increases triggered by the macroeconomic environment. Our framework would have captured that actually really well. So we will monitor over time and are open to recalibrate the framework and reassess risk weights continuously throughout time. Thanks, Rebecca.
I think it's also important, thank you, Francisca, to draw our attention back to the discussion we had on our parallel reporting results earlier as well, and what we're seeing in the self-assessments that are coming in from the credit unions. And we're not seeing any stress on the capital adequacy as a result of these additional metrics that are introduced. We're seeing really the capital landing where we expected it to be with these more risk-sensitive metrics. We are also seeing that the credit unions with less risky or more conservative lending portfolios, it's really opening up their capital and their ability to lend and invest. I don't know, Nez, do you have anything else to add to this discussion?
Yeah, I mean, the other thing that I'll add is, yes, while OSFI may not have considered TDS specific metric, they have certainly introduced something about in the income consideration, which is a loan to income ratio. I think it was last year, and limiting the growth of the portfolio that has a very high loan to income limit. We are not introducing anything like that. We are not introducing that through the either the capital regime or any other kind of guideline. And yet want to capture the importance of the ability of the borrower to service their debt through the income level. So there is some parallel to how OSFI also considers the income level of the borrower, maybe not through a capital charge, but certainly through a guideline, a rule that limits the ability of a financial institution to grow in areas where the loan to income ratio is, as you know, like more than 4.5 times. So there's some parallel there that we are letting go. We're not introducing that. And we're capturing the income through our capital rule. With that, Rebecca, I'll turn it back to you.
Okay. Well, thank you, everyone. We have been able to answer all of the questions received leading up to the session, as well as received during the session today. So we appreciate everyone for attending. And I do want to say a big thank you to the folks that did submit questions in advance. And as mentioned earlier, this session is being recorded and will be available following the session. So thank you for your time, and we look forward to hearing the feedback from external stakeholders as we finish up this consultation. I do encourage you to provide your feedback, and you can welcome to provide it in bits and pieces throughout the process as you go. You don't have to wait till January 15th to get us that feedback. And feel free to reach out to the CU Capital email address with any questions over this process. So thank you very much and have a great day.